Hey everyone, welcome back to Corporate Decoder today. DIRTT Environmental Solutions LTD just filed their quarterly report for the 30th of June 2026, and I'm seeing a mixed bag of signals that we need to unpack. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing some signs of improvement in profitability, but the debt situation and market challenges are definitely worth a close look. Alright, let's dive into this 10Q filing from DIRTT Environmental Solutions LTD. It is their regular check-in on how the business is doing. First up, the balance sheet gives us a snapshot of what the company owns and owes. As of the 30th of June 2026, they have about $14.8 million in cash and cash equivalents. That is down from about $20.3 million at the end of 2025. Not a huge drop, but it is something to keep an eye on. Their total assets are around $87.9 million, down from over $102 million at the end of last year. On the flip side, their total liabilities are about $62.2 million. This means they owe more than they own if you just look at assets versus liabilities. But shareholders' equity, which is what is left over for the owners, is around $25.7 million. This number has also decreased from the end of 2025. When it was about $28.5 million. Now let's look at how much money they made and spent. For the 3 months ending the 30th of June 2026, total revenue was about $40.3 million. This is a small increase from about $38.9 million in the same period of 2025. So sales are up just a little bit. The cost of selling their products and services, called cost of sales, was about $26.3 million. This means their gross profit, which is revenue minus the cost to make and sell, was about $14 million. That is a good jump from about $10.8 million in the second quarter of 2025. This tells us they are making more profit on each dollar of sales. But when you look at all their expenses, including things like sales, marketing, and administrative costs, they ended up with a net income of about $1.1 million for the quarter. That is a big turnaround from a net loss of $6.6 million in the same quarter last year. This is a really positive sign. They actually made a profit this quarter. For the first 6 months of the year, revenue was about $82.7 million, up from $80.2 million in the same period last year. They still had a net loss for this longer period, about $2.2 million, but that is much better than the $7.3 million loss they had in the first half of 2025. Let's dig into those revenues a bit more. The report shows product revenue was about $38.9 million, and service revenue was about $1.4 million for the quarter. The product side is where most of their money comes from. Looking at where the sales are coming from, about $35.1 million came from the US and $5.2 million from Canada for the quarter. The US is clearly their biggest market. One thing that is interesting is their stock-based compensation expense. It was about $0.7 million for the quarter, up slightly from $0.6 million in the same period last year. This is the cost of stock awards given to employees and executives. They also reported reorganization expenses for the quarter. This was about $1.1 million, mostly for costs related to their transformation office, which is aimed at streamlining the business. This is a significant increase from just $0.2 million in the same quarter last year. This suggests they are investing more in restructuring. Now, let's talk about some of the special numbers they provide to give a clearer picture of how the core business is doing. They call it adjusted gross profit margin. For the second quarter of 2026, this margin was 37.0%. That is a solid improvement from 30.4% in the same quarter of 2025. This increase is mainly because they are spending less on tariffs and costs related to tariffs, which had been a big problem. They spent about $0.3 million on these tariff costs in the second quarter of 2026, compared to $2.0 million in 2025. That is a huge difference. They also report EBITDA, which is earnings before interest, taxes, depreciation, and amortization. For the second quarter of 2026, their EBITDA was about $2.8 million. This is a big jump from a negative EBITDA of nearly $4.7 million in the same quarter of 2025. Even more telling is their adjusted EBITDA, which tries to strip out one-time or unusual items. For the second quarter of 2026, adjusted EBITDA was $4.7 million, or 11.8% of revenue. This is way up from a negative $2.0 million, or negative 5.2% of revenue in the second quarter of 2025. This really shows the underlying business is performing much better. Looking at the bottom line, that turnaround from a significant loss to a profit is crucial. For the quarter, they earned $1.1 million. This is a massive improvement from a loss of $6.6 million a year ago. This is the first time they've shown a profit in a while, and it is driven by better sales and especially better margins. For the first half of 2026, the net loss was $2.2 million. While still a loss, it is a huge improvement from the $7.3 million loss in the first half of 2025. The improvement in adjusted EBITDA for the first half of 2026 at $6.1 million compared to just $84,000 in 2025 also points to this positive trend. A small note here is about related party transactions. They had some sales of their products and services to Fortress Investment Group, which is related to a major shareholder. These sales were for about $0.1 million and were on regular pricing terms. Now, let's talk about debt. The company has some convertible debentures, which are like loans that can be turned into stock. On the 31st of January 2026, they paid off their January 2021 debentures, which were about $27.5 million. That is a big debt gone. However, they still have December 2021 debentures outstanding with a principal amount of about $10.4 million due at the end of 2026. This is classified as a current liability, meaning it is due within a year. They are looking at how to handle this, whether to pay it off or refinance it. They also took out a loan from the Business Development Bank of Canada, or BDC, as of the 30th of June 2026. They had received $7.2 million from this loan, with another $5 million expected in the second half of 2026. This loan matures in 2032, so it is a longer-term debt. They have a revolving credit facility with RBC, meaning they can borrow money up to a certain limit. As of the 30th of June 2026, they had about $6.7 million in available borrowing capacity under this facility, but they had not drawn any of that money. Looking at their cash flow for the 3 months ending the 30th of June 2026, they actually generated about $0.9 million from operations. This is a big change from the same period in 2025, when they used about $3.9 million. For the first 6 months of the year, they generated about $2.1 million from operations compared to using $0.2 million in 2025. This operational improvement is a key factor in their better financial performance. So, what is the big picture? DIRTT is showing some real signs of life. Their revenue is growing slightly, and crucially, their profitability on sales, their gross profit margin, has improved significantly. This is partly due to less spending on tariffs, which is a big relief. The move from a substantial net loss to a net income in the latest quarter is a major win. However, there are still risks. Their debt, particularly the December debentures due at the end of 2026, is a near-term concern. While they have improved their operational cash flow, the overall cash balance has decreased. The company is also dealing with ongoing legal issues, like the case against Forkbuilt, which could result in significant damages. Looking at their forward-looking statements, they are optimistic about the rest of 2026, expecting continued operational and commercial improvements. They believe their transformation initiatives are working and setting a stronger foundation for growth. They are focused on improving the quality of their sales pipeline and increasing margins. My biggest concern is their ability to manage their debt, especially that December debenture payment at the end of the year. While they are profitable on an adjusted basis and showing a profit for the quarter, managing their liabilities is key. The improvement in gross profit margin is very encouraging. And if they can maintain that and continue to manage their expenses, they could be on a path to recovery. The risk I am watching is how they handle the upcoming debt maturity and whether the market will continue to recover to support their revenue growth targets. They are also facing general economic and market risks that are mentioned in the filing. Alright, that is my take. Stay decoded. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Like, comment, subscribe, and join the Discord linked below.